Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Thank you for joining us. I'm Lance Pederson, host Real Estate Risk Report. So today I have with me Boots Dunlap with RA Capital based in Phoenix, Arizona. How you doing today, Boots?
I'm doing really well, Lance. Thanks for having me on.
Yeah, my pleasure. My pleasure, man. My pleasure. So yeah, I met Boots. I made a trip down to Arizona. It's probably been, a couple of years ago now, I guess. Met him and their team down there. So these guys do they're lenders, mainly on commercial real estate assets. I'll let Boots sort of get into it more, but we're having him on today to sort of talk about, some of these deals they do. They tend to invest at times in the sort of mezz position or preferred equity position, on larger deals. And it definitely is a great, sort of opportunity, but higher yielding, especially in a yield-starved market that we're in today, right? And so if you know what you're doing, it has the ability to sort of generate what I would call, an above-average risk-adjusted return. So it's an interesting space to sort of understand, not just sort of your garden variety, first lien loan on some rehab property or single family or whatever. It's sort of a different animal, but something that's growing in popularity to capitalize some of these transactions. So, Boots and his team are experts at this sort of thing. So we'll let him get into it. But why don't you share a little bit with us, Boots, sort of your background and really, why did you guys form RA Capital? Kind of how did you get into real estate? And if I recall correctly, I think your father has been heavily involved for a long time too. So.
Yeah, that's right. Thanks, Lance. Well, it's a pleasure to be on the show. Thanks for having me. I'm so impressed with everything that you do. And I think our connection goes back a little bit earlier. I believe I went to a conference in Laguna, maybe back in 2014. And
there you go. That's right.
And I don't know if I met you, but I definitely met another person that was with your firm. And I was talking. And since then, I've come across your firm in many different ways. So it's really a pleasure to be here. But as far as my background goes, you're right. I come from a heavy commercial real estate family, multi-generations of development, grew up in that business. My father was a developer through the RTC and LSNL crisis, which if you grew up in that or you worked in that during that time in commercial real estate, it was a lot of feast then famine. And, a great way to learn about commercial real estate, although probably not an excellent primer for the great financial crisis. The markets reacted very differently when the government decided to form the Resolution Trust Company and corporation and force the banks to purge assets. That really didn't happen. But growing up for me, it was a lot of walking parking lots at night at multifamily complexes with my father in order to, identify how many lights were on and how many cars were in the parking lot to truly know what the occupancy is. These days, there's firms that do that for you, but back in the day, you had to do that yourself, walking sites and trying to understand the hazards within like floodplains and things of that nature. That was kind of how I grew up. So went to school back east, always did internships around commercial real estate. Ended up though, September 11th was my senior year of college and decided to take a little hiatus from getting into commercial real estate and joined the military. Served as an infantry officer for what I thought would be just a couple of years. Ended up getting stop loss and went to Iraq and Afghanistan for about 5 years in total, not there the whole time, but got to, before settling into commercial real estate was good for me because I got to, do the airborne ranger thing and get that out of my system and then come back to what I thought would be a phenomenal commercial real estate market, i.e. the end of 2007. Mm-hmm. And when I got back to the United States, particularly Arizona, where I'm from, things were very different than when I had left and the markets were starting to deteriorate. In fact, my father's 30-year-old development company that he had. And prior to that, he was a partner with Trammell Crow, like one of the real partners of Trammell Crow back when it was Trammell. A lot of other phenomenal experience, but he was having to wind that down. And it was just, sad because we knew that it wasn't coming back anytime soon. And I guess it was good for us because we didn't have any debt or any issues. And, he was at an age where he was ready to kind of retire and move on. But work found him in the form of some consulting engagements. And at that time, I had a lot of free time on my hands. So I started doing consulting for lenders and particularly banks, insurance companies, and private equity groups that were lending on large first residential projects, subdivisions, and then commercial projects about, what they need to do to complete the project if they were to take it back, and what, are some of the things they need to be mindful of and what's the value of it. And then ended up kind of snowballing into underwriting FDIC portfolios for private equity companies and managing insurance portfolios of commercial loans that were in stress and working through negotiating them on behalf of the lenders. They really didn't have in-house special servicing teams to do this. And then working with CMBS servicers as well, as receivers and helping to manage and turn around assets and try to maximize recovery for the actual investors in the loan. And as we were doing this, we started Realty Resolution Advisors, which is what RRA, it's our company, stands for. It's an homage to the RTC SNL crisis, but the name quickly, I think we outgrew it. Yeah, you've gone through some name changes, it sounds like, as of recent as well. Your names are always a lot better. We have terrible names. So we couldn't think of a better name, so we just call it RRA. And specifically RRA Capital is what we go by today. But we ended up consulting assignments turned to asset management assignments, both on like REO and debt portfolios. And then ended up turning into an investment opportunity where we went back to our institutional clients and said, we believe there's an opportunity where there's a distinct dislocation in the credit markets, where banks have pulled back, CMBS has more or less shut down, and there's just a whole world of opportunity in assets that need to get repositioned, and they're going through transformation. And so we were never stressed, lenders lending on stress, but we were always trying to find the value add opportunities, and those value add opportunities started to really percolate in 2012. So that's when we started our investment strategy. Since then, we've raised approximately, close to 500 million in the space from mostly institutional investors, and that's equity. For debt, we typically, borrow as well. And so our loans that we issue borrowers are made up from a portion of debt and equity. But we ended up, being very lucky to have some large institutional partners that have allowed us to grow our business. So, but still, we've continued to look back at getting back into commercial real estate equity, investing in development, and from our standpoint, have just found that we really like the debt space. We've become sort of consummate bears, which is really hard to be a developer if you're a bear.
Yeah.
And we still do like value add, and we understand that, so we're leaning into that experience. But for us, we like the risk-adjusted returns in debt. We think that we can get something that's maybe not as close to equity returns, but fairly close to equity returns, but not necessarily biting off as much as the risk that you bite off, and then also getting far more diversification in our portfolio than you would with just like a typical, let's say, guy that develops multifamily in San Antonio, Texas. There's a lot of concentration issues around product type and one individual and submarket, what's going on there, that we prefer on the debt side, being able to be a little more diverse. And it really came from growing up and seeing constantly, like every 5, 6, 7 years, there's a cycle, and you see all of the guys on the equity side unemployed, looking for jobs, but somehow or another, the bankers are always still employed. And they might be changing banks, but they're always still employed. So So that's how we've decided to grow our company. I know you've got a similar background, so you appreciate the debt space as well, Lance. But any questions, feel free to ask.
Yeah, no, I think it is. I mean, it's interesting, right? So if, like, just watching how the experiences, shape it, right? Like your dad being a developer and, being in that sort of chair and then having to sort of the reinvention and the pivot, for RA Capital in particular, be out of that, right? Where you're working out other people's stuff, meaning you're seeing, I'm assuming, right? Every day you guys are just intimate with the destruction that the crisis, had caused, right? So it's like, what can, I've always said this, like it's way easier to learn off of other people's mistakes than to make them yourself. Right. And so for you guys, like that was like the beginning of RA Capital was sort of cleaning up someone else's mess. Right.
Yeah. So we've got $2.5 billion of distressed workout experience in lower middle market loans, but we've never had, we've never lost money on one of our own deals. We haven't had to really use that. We've been able to your point, gain that education on someone else's problems. It's like the old adage that, wise person learns from other people's mistakes. A fool learns from his mistakes. So trying to learn from others' mistakes.
Yeah. Yeah. And I think that's a good way to go. And so for you guys then, as you started to, originate your own loans and, since you did have, institutional capital partners, but were you typically like, how did you originate or source? Like, how does someone find out about you guys as a lender? Like, what is it today? What was it before, sort of that acquisition strategy? Like how does the borrower, come to know about, RA Capital as a potential solution?
Yeah. And you'll probably appreciate this, Lance, because I know you've sat in the lender seat, but originally, so the channel with which we distribute through, or better word, lend through, originate through, is majority the commercial mortgage banking channel. And typically, the sponsors that are trying to look for non-recourse debt need to use that channel because that's the channel where you get access to CMBS loans, Fannie, Freddie, insurance, life co-loans. Like it's normally, unless you're a repeat borrower, it's a little bit harder to go direct. In fact, a lot of insurance companies won't allow you to go direct. And so it's a great conduit to access that market. There still is, there's no public exchange for debt opportunities. So there's, it's a relatively efficient market, but it's not perfectly efficient. Normally we compete on deals. We're competing with, maybe like 3 to 5 other lenders typically, as opposed to like, public markets, you're competing with the whole world. But that said, the goal is to have, to be able to develop those relationships so that people are, when they call you, they trust you and they're not going to grind you down to the last cent. And we never want to win a deal on pricing. But what I will say is when we first started the program in 2013, it was very hard because we didn't have a lot of name ID or relationships, but it's that concept of a flywheel. Once you get it turning, it goes faster and faster. It starts just growing a lot more. So, I think this past year we had over $18 billion worth of inbound loan requests come to us requesting specifically our financing on their project that required bridge financing. And that was all knowledgeable investors that knew our program that want us to quote it. I think the first year that we did it, we were lucky to have maybe 100 million. I don't even know what it was. But once you're in the market, the longer you're in the market, the more the market knows about you, the better your deal flow is. And there's like a gravity that starts to form for deals. We're still really far away. We're by no means like one of the big players. We pride ourselves on being a very small group that's based in Phoenix, Arizona, unlike some of these very large public REITs and groups based out of the financial centers. But that's been a big part of it. We do have a team in-house that we employ through They use digital marketing means. They use traditional press in the flesh, which through COVID is really pressing the Zoom call and dialing, trying to build relationships with commercial real estate developers and borrowers, but really with the brokers. We don't want to disrupt that channel because they've been very good to us. And oftentimes the brokers, if you hear them talk about the lenders they don't like, they're typically the lenders that go around them. They go directly to the borrowers, and we never want to be branded as that. We really love and respect our brokerage relationships.
Yeah, definitely. So when you guys bring these deals in, so it sounds like you've got, pretty good deal flow. What is sort of disqualifying? So most of the turn downs, sort of what is your typical turn down and why? Like what is it about the transaction that, is generally will cause you to sort of say, pass?
Yeah. So we've got through our pipeline as deals are going through, we've got a little bit of an assembly line. We've got the first guy that's kind of the sniff tester, and he's also doing a lot of the outbound outreach to trying to kind of, gin up more activity for us. But, the easy ones are, we've got too much allocation to this product type or this geography we're not a big fan of, or the loan size, or, just you can tell by looking at it that the quality of the borrower or sponsor or the asset just isn't the sort of one that we normally traverse in. And so we, but more like, getting down to the nitty gritty, on the equity side, it's all about obviously underwriting the real estate. Debt's a little bit more challenging, but maybe it's not. I don't know if it's a minus, but I'd say maybe there's positives and negatives to it. But you also have to underwrite the borrower and the sponsor. And so early on, when we started, we are real estate equity guys by trade, and we're very focused on the asset, but found that it's far better to spend more time underwriting your borrower and his ability to execute the business plan than the asset. So even if you have a great, beautiful asset that's in a great location, if you have a borrower that doesn't have the ability to fully lease up that asset, or the relationships he needs to be successful, or the experience, or the net worth, quite frankly, that's going to be required, that probably isn't as good a deal of a guy that's very well capitalized, that has a ton of experience, and he's buying, what we would probably look at on the equity side is like, oh, that's not that great of a location or great of an asset. But when you got a sponsor that has that track record, he's willing to put his money in, and he's done this several times before, like that speaks volumes. So, on the front end, sponsorship is paramount. Obviously, real estate collateral is very important too. I'd like to think that we're better at evaluating a borrower's business plan to improve and stabilize the property than other people, just by virtue of our experience being sponsors, developing and improving and doing value add commercial real estate. And I kind of liken it to, I don't know, is Fairway America, are you a golfer, Lance?
Yeah, I'm a golfer. Matt's a golfer. Yeah. So
it's like when you're golfing, I don't know how much you golf, but if you're going out, let's say if there's a pro, if he were to golf with you, Lance, and you were to tee up the ball on the first hole, as soon as you tee it up, the way you stand and the way you're poking that in the ground and taking your warmest swing, like he would know pretty quickly how much golf you play. We're talking a pro, right?
Yep.
How you grip the club, sort of thing. And it's a little bit similar when you're a group that has an equity background and you're tasked with evaluating, particularly a value add, development background, and you're tasked with evaluating another guy that thinks he can add value. And so I'd like to think that like we can very quickly size up someone as they're teeing up that deal. So, I mean, that's a big piece of it too. But obviously there's a lot of market data that we're using through subscriptions to CoStar, Real Capital Analytics. We're doing Argus runs, in order to discount cash flows on, the prospective value or the stabilized value of the asset and what it's worth today if you were backing into it. And we're making calls with local brokers and, doing site visits and getting third parties and doing all these other things that you have to do. But generally speaking, sponsorship is by far the most important thing.
Yeah. And it sounds like you're always structuring them as a debt instrument. I mean, it seems like the notion of pref equity is becoming more prevalent. I mean, maybe you could get into that a little bit of, what the differences are of, you kind of sit in the same position, but, one's equity, one's debt. And two, just maybe touch on, because you're always behind someone's, I guess I should, you're not always, are you always behind someone else's first, like with the stuff that you're doing? You're always like kind of in a mezz debt or bridge, or will you at times be in first position with just like the bridge loan?
Yeah, no, it's a great question. So we have two products for commercial real estate borrowers. We have senior mortgage, which we provide, we're direct lenders on. And then we have a mezz pref equity product, and they're basically the same deal. The only difference is with mezz, it's a recorded lien on the property, whereas pref equity, it's recorded lien, not recorded. It's not recorded. It's sort of lien within the partnership or the ownership equity. Mm-hmm. And so, it's more common. Mezz isn't too common anymore because since the great financial crisis, a lot of, traditional lenders don't really allow it or like it behind them, another recorded lien. And so what's more common is pref equity, but even still that needs to be coordinated with the senior lender. And so we do pref equity deals, but I would say about 90% of our deals are senior mortgage. But even in the senior mortgage loan, we're not doing hard money deals where, we're trying to get, lend money out at a double-digit return and get a double-digit return. But we are trying to lend money out at like a single-digit return where we feel like the quality of deals is much higher, and then use leverage in that loan. And so we will borrow. And so, we talked through on like a look-through basis. There is, a hypothetical sort of B piece that's being created in our loans because we do have debt and equity in our loans.
Yeah, So you're basically out of the investment vehicle, which is a pooled fund of many loans and ostensibly many investors potentially. You'll have a first lien loan against some property up to what? What do you guys typically? What are you going to go to? Like, how much do you need? How much equity behind you do you need on a deal like that?
Yeah, it's a good question. It's all product type related and where we're on the market. So, multifamily has the highest advance rate. So we would go up to 85% LTV on multifamily. So 15% of the full capitalization of the deal is coming from our borrower. However, when COVID happened, we pulled that back. So I think multifamily now we're closer to like maybe 75, 80%, maybe even 65%, depends on the deal, location, what's going on. Hospitality would be the opposite end of the spectrum. That's always like a very low advance rate. That's like probably at best pre-COVID was maybe 65, 70% LTV. And now through COVID, if we haven't done any deals like that, but if we were to do a deal, it'd probably be like 55% LTV. The product types that are in between that from like a highest advance rate would be obviously multifamily, then industrial, and then after industrial, retail and office. I don't know which one's worse, but they're both, I'd probably say actually special purpose product types, and then maybe retail, office, and then hospitality after that.
Yeah. So it's fluid, but it gives you a sense of sort of, where you guys are coming in. And then so it sounds like if you are becoming in behind someone else's first, like it's going to be structured more preferred equity. Obviously that makes it easier to get access to the property, which I suppose is having development background. Worst case scenario, you're probably, once again, not getting in the deal to take the property over, but if you had to, worst came to worst, you could. Is that kind of how you guys look at it?
Yeah. So we have still the consulting arm. So we have like an in-house special servicing team that we have not needed, knock on wood, to service any of our own assets, but there are some institutions that still have assets and that they hire us to turn around and manage. And so we've got that capacity in house, but we fortunately aren't really needing to use it for ourselves. But we're not a loan to own shop. I think one thing we've learned through the crisis is through the great financial crisis beforehand is the best person to get a project that was really a victim of some sort of existential crisis like COVID or, the energy crisis, something like that, to get it back on its feet is probably the borrower that we first bet on, unless he's kind of demonstrated to us that he's like untrustworthy or he's fooled us and he's really ignorant and unreliable. Then, that would be a different situation. But we'd much prefer to work something out with our borrowers as opposed to taking them back. That said, we have a fiduciary responsibility to our investors to maximize value. So, if it looks like, it's just really easy to take back and liquidate on the market and make our investors whole. We'd love to play nice guy with the borrowers and, work things out. But unfortunately, we're not running it like a charity either. We need to take back that asset and make our investors whole. That said, I could make a case to our investors that taking back an asset would be short-sighted, just because the reputation in the lending market is so important. And if you get branded as a group that becomes unfair to work with, or that's really a loan-to-own shop, that will, hurt your ability to be competitive when trying to, convince some really good borrower to pay more money to work with us than, someone else.
Yeah, exactly. So I know you guys developed some software, like proprietary software internally. Was that done to solve some particular issue in the underwriting or the analysis of?
Yeah, so it was. Through our consulting projects, we realized that debt was being managed as like a fixed income instrument, more like a bond. And, this is, it's just amazing when you get into banks and you're asking them, what the borrower's telephone number is, or square footage of a project, or the date it was built, things like that you'd think they would know, or like a really recent copy of the rent roll. And none of that stuff was really organized in one place. And then the way they're valuing this asset is like on a cap rate basis. So, okay, we collect financials once a year, and we normally get those financials from our borrowers, maybe, 3 or 4 months late, because it takes a long time to get them to turn those in. And so really you're looking at numbers, and we'll take like, on that financial that you got, if it's, last year's financials, you're really looking at income from, over a year ago. And then you're applying like a market cap rate on that income. And you're saying, okay, that's today's value on the asset. And, it doesn't take into consideration lease roll, credit quality of tenants, what's going on in the market in terms of absorption and vacancy rates and where lease rates are today. And so it's really like a backwards look at real estate. And it's like a year backwards look at real estate and the asset. And these assets are like, they're living creatures where they need to constantly be fed and monitored. And, there's tenants that are rolling in and out of buildings and expenses that are going, unforecastedly higher than thought of. And so the NOI that you're underwriting from like a year ago isn't really going to be the NOI this year. And so really trying to move to a model where we're taking data on a monthly basis, just like we would if we were an equity shop. We're updating our cash flows and running new discounted cash flow analysis on the assets. We've got flags and alert system that has ticklers when there's, for our asset managers, when there's, big leases that are going to be rolling. So we can check in with the sponsor and find out how leasing's going on those, or, aspects where you take back, some of these projects and they didn't have their UCCs, they had expired on the asset, and those need to get, renewed every 3 or 4 years. And that asset ended up taking extensions. And so they didn't renew the UCCs, which for those not listening, I mean, that's one of your liens on the property, and to not renew, that's like pretty bad. A contractor can go in, file a lien, and then they take priority on you. So, and there's a lot more around like keeping the insurance and making sure like when we read a loan, we're just saying that you need to have it needs to be insured for, $5 million. And that's just like the property. Then there's like general liability and the flood and the environmental and the earthquake insurance. And that all has different credit rating requirements and minimum and maximum occurrence requirements. And so, the borrowers, that's an annual policy that they're renewing, they're changing. And a lot of people aren't checking to make sure that like those covenants are being met. So we wanted to automize everything to make it a little more streamlined and simpler for us to be looking at debt like we look at equity and like we manage equity. And then when you start gathering all that information in one repository, you're like, okay, this is pretty cool. I can now start sharing this with our investors and adding a lot of transparency. And I can start putting in some more analytics to come up with some more, decision making that can allow us to look at performance and what's worked well in the portfolio and what hasn't worked well. And, I'm not going to lie, like this isn't AI where this is a self-aware computer that's making investment decisions. However, it's a really helpful tool that allows us to automate a ton of our processes and then be able to dig into data when we want to and run like analysis in different areas. And then also kind of have live updates on what's going on in a portfolio and what we need to be tracking and spending our time on from like a manager perspective. So that's, before it was like, we'll wait for till we have a default and then we'll deal with the situation. We like to, we don't want any default to come as a surprise. Like we'd like to know 6 months out if we're going to have default.
Yeah, no, I think it is. I mean, everything you mentioned there, right? Like that's all risk mitigation. I mean, ultimately, because that is how you lose. Like you said, the policy lapses or the coverage limits weren't appropriate, and that's a surprise. And that can mean that's loss of principal, right? Like that's how you lose money in this business. But that's the kind of stuff that administrative, because ultimately it kind of comes down to that, right? Chasing after them, making sure you're loss paying the policy, making sure that the policy is actually like covers what you need it to cover. And, it's a pain in the butt, right? But,
Lance, you tied it all in. I'm glad you circle us all back to risk mitigation.
Well, it always does. Yeah. It's just, but it is. That's what I mean. There are all these little things, but and that's why I like with, when you chat with lenders, right? Like, it's super professional investing. I mean, you've got to make darn sure because you're not in control. And I guess for me, like the primary audience is the passive investor. Like you're not in control. You don't have any rights. You don't have voting rights. You can't do anything about it. But unlike in their position, they're at least like have some cushion of some kind. Someone else is going to lose the first dollar. And it's usually the people that we're trying to help today on the podcast, right? Like you're in that first loss position now. Now, one way you can look at it is like, well, if there's a reputable lender that's kind of in first position, then they're going to, they should be checking all these things too. But as I think you can ascertain from Boots here, right? Like not all the lenders do that. Sometimes all this stuff, like you said, you'd think that they have all these answers. Most of them don't. And being, having developed software ourselves, I know that no one goes and develops their own custom software just for shits and giggles, right? It's like you do it because the solution doesn't exist in the market, right? Like,
so this is our third iteration of software. We've switched platforms, languages, like development teams, and every time we do it, it's the question: do we buy or build? And the problem is, there's nothing in the market. That there's starting to be a couple products that had I found out about them and had they been really available 2 years ago, I might have said, well, we can live without some of this functionality because but there's a part of me selfishly too, and you're probably going through this where like you get really attached to your functionality that you want. And when you buy something off the shelf, like it's just not going to be tailored to, everything that you want to manage from a risk mitigation standpoint. I think you also bring up a really good point. What frustrates me, and I hope you probably might get this as well, is everyone with money thinks that they can be a lender. Thinks like, why invest with you? I have my next door neighbor ask me for money all the time, and I just lend it out to them. Yeah. And that's where you start really playing with fire, I think, because you're not doing those things like making sure like you've got a rock solid agreement that's being vetted by, attorneys, and you're checking the zoning and the title, and you're having third parties to make sure that all the encumbrances are cleared, and you're doing the things like making sure UCCs are being filed and they're being renewed, and the insurance certificates in case that project burns down, like you've got no risk, you're made whole there, and there's remedies, in place. And then just the actual underwriting, like, unless this is your full-time job, the markets are competitive enough. I hear what guys that do this on their own get paid. And I'm like, man, the risk that you just took, like, you got to know if you got to realize that you must be the cheapest money if they're coming to you.
Yeah.
So
Yeah. That's right. And it does seem, and that's it for many in many states, right? The lending laws are just very, very lax. And so, it sort of the door is open for them to attempt it. And, but you have enough of these conversations, and I'll ask you this question as we wrap up here too. But I mean, that's where a lot of people, they try it and they get burned. And it's always on something like that, right? It's one of those, it's the little things, the little box that didn't get checked or whatever. And that's how they, lost a bunch of money. And it's just, and for me, that's why I like to do this podcast, is like, okay, the good news for investors these days is that you have access now, meaning you can participate in these things, right? But like anything, even if it's the stock market or whatever, I mean, you've got the whole Robinhood now, where people, it's like a casino. So it's good and bad, I suppose, but we have access to it. But you really do have to understand and fully appreciate what it takes to be a professional investor, right? To wake up every morning, to come to work, and to execute your strategy. There are so many moving parts to all this stuff. I mean, you hit on that one, a short while ago, the financial statements. Like, it takes 4 months to get a financial statement. See, that drives me crazy. Like, that it shouldn't be that way, right? But that's why we exist. We're here to say, like, there's no good reason why you shouldn't be able to produce a financial statement on a project within 30 days. I mean, like, there's no good reason why you can't. And I'm tired of hearing, I'm tired of being told that it's not possible when I know damn well that it is. Right. And so, and this it goes to the transparency stuff. These are the things that need to be cleaned up, right? So that, one, investors can appreciate more what it goes into this, and they can differentiate between guys that are pros and really good and those who aren't, and stop this madness of leaping at, crazy returns and promises that are just unrealistic, right? I mean, that's the danger of it. When you think about it, the regulatory regime that is in place really only picks up at about 150 million, right? So that's, the SEC, like, that's when they pick up. But everyone that operates below that, which is the vast majority of all the activity, it's just basically, it's Thunderdome, man. Like, you can do whatever the hell you want to do, and people do, right? Mm-hmm. And so it's, that's what it is. It's all about, when someone's making an investment, you have to look at it and say, what are the inherent risks of it? And then to what you guys do, that's what the pros do. How are some of those risks, as many of them as possible, being mitigated, right? And proactivity and keeping tabs on everything is one way to really, to mitigate risk. And to me, that's what ultimately results in the potential to generate an above average risk adjusted return, right? That's how you do it. Right. And, and then once again, and using a little bit of leverage to go into first position, and, you can create a great consumer facing investment product that solves a problem in their portfolio. Right. But it's to think that it's just magic that happens and that anyone can do it is, it's not that simple. So, so with that said, what is the one investment? I know you guys have had a really good run, but maybe it's not something you guys have done or whatever, but like, what's like the biggest implosion you've seen, or like the one that you wish you could have back, or, that just in terms of investment gone wrong, right? So, and it sounds like RA Capital, you guys have, you came up out of the thing. We've had a good run here, and you've figured out how to avoid it. But have you seen or been a party to or seen, deals that just imploded, like maybe in your backyard, or things that are other lenders that do what you do that terrify you? Like, oh my God, I can't believe that they're making deals like that.
Oh yeah. Every day. So it's like, it's when, you see a deal and you pass on it and you think, oh gosh, like, this is terrible. And then you find out that it got financed, and you're thinking, oh, those poor guys, whoever financed that deal. Yeah. And normally it's like a deal that comes by and you get it 3 or 4 times over the course of a couple of years, because no one will finance it. And like, the mortgage brokers forget they sent it to you. And they're like, oh no, I've already seen this one. I've passed on it 3 times. But there's some interesting stuff. We're having conversations right now, and there's a lot of, like, I don't want to, like, specifically, there's not one asset that comes to mind. I mean, there's a lot of questions about office which are very legitimate right now, and where that product type's going to go. We've seen some interesting pivots where we're in this unique spot where hospitality normally it's very expensive. I mean, if it's performing well, they can be very lucrative. However, it's, worth nothing right now. There's a lot of hotels that are, vacant. And so how are we going to fill those hotels? So there's like this emerging product type of like this studio apartment complex that is basically just a hotel that people are going to, trying to buy and convert into a multifamily product. And it's something that doesn't have a kitchen in it. It's, it got, maybe they might put in a little small kitchen, but like really low ceilings. It's a hotel room. When you walk in, you're in a hotel.
Sure.
And, I'm curious, we're watching this closely because there's obviously a ton of opportunity with hotels that now can't be used. And who knows what happens with travel. Like here, you and we're on video, and it's funny, like if I was talking to someone and I wasn't willing to fly out there and meet them in person, they'd be insulted if like I attended a meeting, other people were there in person, and I showed up in video. But now it's like I'm being environmentally conscious and saving carbon emissions by not getting on an airplane. Like it's the opposite now. So I know that we're not going to be doing as much traveling. So I assume that other people probably aren't going to be doing as much traveling.
Yeah.
And it's more accepted. So what happens to all of this multifamily or all the hospitality? So it could, people get into that space and very quickly you can have probably too much supply. Will that work? So I think our idea is, okay, we're big enough where we can dabble in it, experiment, and see how it goes with like something that makes up less than 1% of our portfolio. And if and there's not a whole lot of risk there, and it ends up being something that's fruitful, like we can lean into it. But we can look very stupid too if like we as a debt provider doesn't have a lot of upside, that we lean into a strategy that really like the equity is going to do really well, but the debt, will it do that well? Like we only have downside in that. So you want to make sure this is proved out a little bit more before you lean into it fully. But that could backfire. I mean, those are issues where it can be pretty binary. If you have like a hospitality project that's really old, like for example, there's, I won't say the name of the flag, but it's an old flag. That's, if it doesn't work as multifamily, like it's probably never coming back as hospitality either. So it's a very binary outcome.
Right.
And, when you're a lender, you don't want binary outcomes. Like if you're equity and there's a chance where you could be like, doubling your money, you'll take a binary risk. But so I think those are the lenders that are doing the binary risk that worries me.
Yeah. No, and I think that's a great way to look at it. It's like you said, it depends on what chair you're sitting in. Right. And it's a risk worth taking when you're in the equity chair because, you know what you're getting into. The lender, and this is part of why we got out of the lending. I mean, we still do a little bit of it, but that was the thing. Like, man, we sure do dig into these deals, and our upside's capped. Right. And, so you've got to assess it from the different seats because it obviously changes sort of the perspective. But yeah, it is going to be interesting. And I saw this morning that, Alex Rodriguez is partnering with some, I forget who it was one of the bigger firms with $650 million fund to go buy, hospitality. Right. And so it's going to be interesting. Right. I mean, to watch, how that stuff shakes out, but definitely from a lender's perspective, right. Like, you're not really in the position to be the one who's going to go all in on something like that. Or if you are, once again, like you said, it's just, it can get pretty scary because, there's not many moves. It's binary. It's like either going to work or it doesn't work. And you don't want to be in that position.
Yeah. I bet, A-Rod and J-Lo, they probably have some smart people managing their money. So I assume that they're going to do pretty well.
Oh, I'm sure. Yeah.
If it was just A-Rod making the investment, like himself, that would be terrifying. But he's to the point where he can hire other people to do this. No,
and that was they used A-Rod so that guys like me would actually pay attention to what the announcement was. So it's like you got my attention. Okay, A-Rod's involved with something. Yeah, he's the token guy. But you see, and I'm not surprised. You knew you were going to see it, and I've and you have guys that call and they talk about these things, and that's part of the issue is that it's. When it comes to this stuff that is sort of boom bust, take a run at it. It's hard if you don't have, it's just most people aren't in a position to kind of make a run at those things because it just seems a bit scary. But anyway, good stuff. I'm glad we were able to catch up.
Yeah,
Good conversation. That's definitely right up the alley. Good perspective. I appreciate you taking the time to join us.
Yeah, thanks so much. I appreciate you doing this. And I hope to see you back in Phoenix, or hopefully I can go to Portland. We just closed on a deal in Portland. So, maybe I can do a site visit, and swing by and meet you.
Well, there you go. Yeah. I definitely should make a trip to Phoenix because certainly it's too cold to play golf right now. I'm like, it's just too cold. I'd like the idea to go play golf, but I need to go someplace warm. So
come on out. It's socially distanced sport.
There we go. That's right, baby. All right, man. Take care, Boots. See you.
Yeah. Thanks a lot, Lance. Appreciate it. All the best. Thanks for having me.